Part 3 of our three-part series is around bonds and interest rates. And if you think back prior to 2022, we had a relatively flat interest rate environment for 12, 13 years. So first and foremost, here we are, 2024, and we're starting to get some actual true return on cash that we put in savings and money market accounts. Well, why is that? Well, the Fed funds rate is an overnight rate that allows banks to loan money from one another. This overnight rate allows banks to meet their minimum deposit requirements by holding the funds that they need overnight, and they pay an interest rate for that. With that, those rates then typically correspond to rates that we receive on treasuries and savings accounts that we have our own money in. So here we are again, 2024. I'm going to give you a few numbers to where we are right now and explain what this really means. July 1st, 2024, as you can see on this chart, shows that the current interest rate environment is showing an inverted yield curve. Well, what does that mean? It means that the yield that we receive on our shorter term assets is higher than the yield that we receive on our longer term assets. So currently in the yield curve for a 1 month time frame, we're receiving 5.48% on our money. Substantially higher than what we're receiving for 5 years, which is currently 4.44%. And if you go out even further, 10, 20, or 30 years, you can see those numbers are lower. All right, so what that means is that the government today feels that interest rates will be going down over the long run as opposed to going up. When we put our money to work, we typically think in terms of a normal yield curve. The longer we put our money to work, the more return we should expect to receive. So if you're giving your money to a company or a bond for 20 or 30 years, you should be rewarded for that amount of time that you're giving your money away, that you can't do anything else with it. That's a normal yield curve environment. So currently, as I said, we're inverted a little bit, which means that you are receiving a higher rate of return today than you will in the future. All right. This also means that the government is looking for you to save as opposed to spend. You are not being incentivized to spend your money. You're being incentivized by the government to save your money. Currently, the goal of the government is to reduce inflation. That's why they're giving you a higher rate of return to save as opposed to an incentive to spend. So let's look at 2019, so 5 years ago, July 1st, 2019, the yield curve is also a bit inverted, but not as inverted as it is currently today. So at a 1 month time frame, you're receiving a 2.17 rate of return. As we work our way down the line, a 1 year rate of return will yield you 1.94% and a 5 year return 1.79%. So again, still inverted, but not as grossly inverted as it is today. And overall, rates are pretty low. So in that environment 5 years ago, the government was saying, we're okay if you spend, we're okay if you save, the economy's okay, and we kind of like where we are, but we're not really going to give you an over-incentive to do one or the other. Now, if you take a look at this chart and you go back to July 1st of 2014, you're seeing that the yield on a 1 month rate is 0.03%. If you work your way out to the 5 year side of this equation, it's 1.66%. So the yield curve in this environment is normal. You're getting a higher rate of return the longer that you put your money to work. However, the key is interest rates across the board are extremely low. The government is asking you to spend. There is no incentive to save. So with that, that should be a clue for anyone that has money to put it to work. Don't save it. Make sure you're spending it or saving it in an investment environment. Finally, I'm going to go all the way back to 1994. So July 1st of 1994, if you take a look at this chart, you are now seeing that the yield curve is, for the most part, normalized and rates are relatively high. What I mean by that is 4.32% is what you can expect at a 3 month term, 6.95% is what you can expect at a 5 year term. So with that in mind, we're now in an environment where you're getting rewarded for putting your money to work for a longer period of time. And that is something that is telling us that is a normal interest rate environment. Again, with interest rates being as high as they are back in 1994, the government's also incentivizing us to save, not to spend. So what does this mean to you? Well, in many cases, we go to the bank and we see what kind of interest rate we're going to receive on a savings account, and we either decide to put our money there or not. There's additional clues that we should be paying attention to with this yield curve environment to understand what the government is trying to get us to do, which will help us understand what's going to happen in our investment environment. In many cases, when we've got the ability to save at a high rate of return, it will typically tamper investments to a degree, and yields or returns in stock market type investments may be lower. Not always the case, but that may be the case, and we should pay attention to these signals. When we're thinking about what time frames we're going to invest in, whether the interest rate environment is high or low, that's something that has to be factored into the equation. If we think back to 2014, it's easy to look back now and say, should I or shouldn't I have invested in 2014 based on where interest rates were? Well, it's clear as you look backwards, you absolutely should have invested because we were being incentivized to put our money to work. And the markets worked the way that they were intended to work based on where interest rates were. So again, these are all things that should come into the equation as you make the decision on whether to put your money to work in a bond or fixed type of environment or a stock. This also comes into play when you think about what your blend should be. How much should you own in stock-based type investments? How much should you own in bond-based type investments? Whether you do your work on your own or you do this work with a professional, this is something that should be checked in on a regular basis. Six months, a year, take a look, figure out where you are, figure out what you need, figure out what you expect, understand your risk, and make decisions appropriately. This is not a set it and forget it type of thing, and there are always signals that are out there that are being sent to us. It's just a matter of whether or not you're picking them up.